Hello, this is Rebecca Benneyworth. This session for Tolley Seminars Online is on the Budget 2015 and looks at the personal tax measures, including savings and pensions. On personal tax, we've got little in terms of major changes for the 15-16 tax year, but the Chancellor did take the opportunity to announce, if re-elected, what he would plan for personal allowances going off into the future. Some quite substantial rises coming through still in the personal allowance. He's also made a commitment to increase the high rate entry point over the next few years if the Conservative Party is returned to power. On tax rates, we knew about the 0% starting rate for savings on a band of £5,000. That was legislated for last year. But what he did surprise us with was a new exemption for savings income. That will come in April 2016 and will exempt from tax completely the first £1,000 of savings income for basic rate taxpayers, £500 for high rate taxpayers and no allowance for additional rate taxpayers. Of course, if your savings income mainly comprises dividends, if you're a basic rate taxpayer, you won't see any benefit from this because your dividend income will not carry a repayable tax credit. But nevertheless, for some savers, this will be a useful development. It'll also be quite pleasant for the banks, who will actually no longer need to deduct tax at source, and savings income will be taxed through PAYE. HMRC will start automatically coding out in 2017. On company car tax, no good news here, I'm afraid, although in the budget speech it sounded as if the Chancellor was going to do something particularly on the very low emission cars. What he has done is for 2019 put it up less quickly than he has hitherto. So no good news. All of the announcements that we already had showing substantial rises in company car tax will go ahead as planned. And by 2019, the bottom level on the table, ignoring very low emission cars, will be 22%. So really quite huge rises for some drivers. In terms of other related benefits, fuel and van benefits, the fuel benefit for cars base figure is £22,100 for the next tax year, and the Chancellor has said he will increase that by RPI. Now, fuel prices are dropping, and you will need to think quite carefully about those clients who do have a company car and free fuel for private motoring. It is unlikely that very many will actually see any value in that, so you should review that before the 6th of April ideally. A few points on P11D simplification in the notes, but much of this has been around for a little while. It does see some major developments which could, in the end, see the end of P11D. So the £8,500 threshold will be abolished. There is an exception for ministers of religion, and there's also going to be an exemption for living accommodation provided to carers. There's new trivial benefits exemption replacing the guidance in the Employment Income Manual by a statutory exemption for trivial benefits up to a value of £50. It's not expected that employers will be using this very widely, but there is an additional restriction for close companies and for office holders in close companies, limiting them to £300 a year, which seems sensible. Payrolling benefits will have enabling legislation to allow benefits to be taxed through the payroll. I think this is a development that will build as software companies provide the software to do the job. And then finally, the statutory exemption for reimbursed expenses. We will see the legislation around dispensations abolished, and we'll see a statutory exemption which will mirror the current deduction for employee expenses, but essentially provide an exemption at source. This won't be available if there's a salary sacrifice scheme in association with the travel expenses. The changes on umbrella companies may have a nasty shock in store for IR35 safe clients, those clients who operate through their own personal service company but are not caught by IR35. Umbrella companies have been exploiting the temporary workplace rules and have been able to get tax relief on travel and subsistence that wouldn't normally be allowable for normal employees. HMRC is now going to restrict this tax relief and effectively put those people who work through umbrella companies in the same place as all other employees, and that is not able to claim on travelling expenses to a permanent workplace. The way they'll do this is by using some techniques that they used in relation to agencies last year, looking at workers under supervision, direction and control of the end user, rather than bothering to go down the road of looking at the employment test. So might be some quite nasty shocks there for people operating through IR35 type companies. Remittance basis charge, well, we already knew this, but a quick reminder for you, there'll be a new category of remittance basis charge that will apply to people resident in 17 of the last 20 years, and the charge will be £90,000. The middle band for those resident between 12 and 14 years will increase next year from 50,000 to 60,000, so some quite substantial rises there. On pensions, we've seen an announcement about the lifetime allowance, and that really had to be a sort of bit of an obvious one to go for, given that the main opposition party has also announced the same intentions. So although it happens in April 2016, you can be pretty sure that the lifetime allowance will be reduced to £1 million in 16. We will, of course, have protection for those with funds in excess of £1 million, as we have before, but it does just add even more complexity. The sale of annuities, publicised in the weekend before the budget, those who have already taken their pension and have an annuity product will be able to sell that annuity either for a cash lump sum or for some other form of financial product. That will come in April 2016. And the government is predicting some pretty hefty tax receipts from that measure. There's also a change on the treatment of inherited annuities. This is where there has been either a joint life annuity, so that the survivor benefits from the annuity, or a fixed term annuity where there is a beneficiary who benefits. If the policyholder died before the age of 75, then the annuity will be tax exempt on the beneficiary, and that starts in April 2015. On savings measures, we've got one or two areas here, notably the Help to Buy ISA. Now, there's quite a lot involved in this, but government will add £50 for each £200 saved, and that will give a maximum addition of £3,000. There'll be the new exemption, which I've already mentioned, is a personal savings allowance. ISAs, there will be an allowance to withdraw and then replace the funds within the tax year, without that counting towards your investment for the year. So I think flexible ISAs quite welcome. New ISA limits are in your notes. They were announced following the autumn statement, and the 65 plus bonds will be available for a little longer, and it's expected that's going to bring in lots of extra money. Now, in your notes there are one or two points on some of the less common areas, a little bit about tidying up of venture capital trust investments and so on, but those are the key measures affecting personal tax, pensions and savings in the budget 2015. Hope you found it useful. Thank you for listening.